Hello and welcome to this new video. Today I'll show you Netflix's quarterly figures, how they can affect the stock price, why there wasn't a price increase, and then I'll present my price forecasts. Let's begin. First, I want to address the quarterly figures. Netflix's revenue. This quarter was $9.4 billion with a profit of $5.28 per share. Profit per share is very important for shareholders because it shows a company's performance. Why aren't these numbers normal? Because the company significantly exceeded analysts' estimates. Now let's look at Netflix subscriptions. Netflix gained 9.3 million subscriptions. That's over 70% of the estimate and has set a new record for paying customers. There are estimates that 500 to 700 million people watch Netflix because most accounts are often used by multiple people. This growth again shows that Netflix still has a strong brand position where they can increase their rates. Now comes what disappointed most investors. A subdued outlook for the next quarter, which isn't so good. But there were no price movements due to the quarterly figures. This shows again that future prospects matter more than current results and that the stock market is very emotional. The surprising thing is that Netflix fell by 3% after the earnings report, which is actually inexplicable if you were to look only at the news. Now let's look at how volatile the Netflix stock was. Kobayashi Letter writes, "The stock just swung over 10% in a matter of minutes after reporting results, which is a lot. During this time, amounts of more than $30 billion moved. Because of this lack of rationality, many investors are now wondering if the stock is still worth it." Before we look at the fundamental data, I want to do a giveaway. You have the chance to determine a video topic. Whether it's a stock of your choice or portfolio for a situation, you can win by following the channel, leaving a like, and writing a comment with your wish. It shouldn't be investment advice. Now back to the video, let's go through the fundamental data. First, I want to reassure everyone. Netflix has no financial problems or risks. The analysts and I have not identified any significant risks. Netflix is a streaming service that is profitable, which is very important because most streaming services are unprofitable. And the ratios in comparison are still within realistic ranges. Netflix has a market capitalization of almost $300 billion. My estimate is that Netflix can reach a market capitalization between $400 and $500 billion in 2025. Looking at the ratios, Netflix has a PE ratio of 43.1 and a PS ratio of 7.9, which is high, but still okay for a growing company. When we look at the competitors, they are Walt Disney, Tencent Music, a music service provider from China, Warner Brothers, and Spotify, which are not yet profitable. Netflix is still realistically valued as a profitable company. Disney is currently valued so high because they just recently became profitable, and Warner and Spotify are still growing very strongly, and one of these stocks is also very undervalued. When compared to the largest technology companies, Netflix is still growing very strongly. Now, let's look at the price to earnings in historical comparison. There were times when Netflix's PE was over 80, and between 2022 and 2023, it offered a unique opportunity to buy at a PE ratio of 15.2 during the correction. Netflix's valuation is currently ideal. It's neither over nor undervalued. I could still allow the stock a PE ratio of 50 before we would see a stronger correction. Now let's look at the future prospects. The future prospects look quite strong. The earnings growth rate is expected to be 16.4% and the EPS growth rate should be 17.2%, which is very good. I want to show you the visualized representation of this for the future. Netflix's revenue is expected to be $48 billion per year by the end of 2026 with a profit of $11 billion compared to today's $35 billion and profit of $6 billion. With the Netflix stock, you can perform at least twice as well or even better than the market. I expect an average performance of 30%. Now let's look at a very geographically important statistic. Many have concerns that a few giant companies are too dependent on China and would fall very hard in a crisis. I can reassure you about Netflix. Netflix is not dependent on China because they are not allowed to publish their services in China. It's ambiguous. If they were in China, they would very likely have stronger growth, but with risks, and currently they still have high growth without China risk. The largest market is Western countries, which reduces the risk for Netflix, and it can be positive for the future. Now let's look at how efficient Netflix is. Netflix has a return on equity of 32.1. Netflix has a 15% return on investment, which is almost triple the average, and return on capital employed for Netflix is 19.9%. And 3 years ago, it was only 17.4%, which is a very good increase. Now let's look at the balance sheet. The health looks mediocre. The debt-to-equity ratio is 65.6%, so $17 billion, which is quite a lot. And they only have cash of $7 billion. But you shouldn't worry too much because the assets and liabilities are significantly higher than the debt. And the debt will not be a big burden for Netflix because it has been decreasing in relation to equity for years. Now let's look at something very important to me, the ownership. Institutions own 82.4% of the outstanding shares, which should reduce volatility, which is not really the case, and even the institutions are holding back or making wrong decisions in this market phase. The largest shareholders are Vanguard, BlackRock, and the other major asset managers. Now let's look at the detailed analysis. Don't forget to subscribe if you like the video. Netflix is almost in my target zone, where we will then see a 20 to 30% correction. There is an alternative scenario that we don't enter the target zone, but instead make the medium-term correction now, which brings us back below $600. I still wish the stock would run up to break through the all-time high. It would give the stock further strength for other impulse movements. I entered at the purple zone and am strongly in profit. I will sell almost half of my Netflix shares in the short term because I want to enter other very interesting stocks. If you want a stock analysis of other streaming providers, write it in the comments. For investors among you who buy stocks for 5 years or more, the Netflix stock is very well suited, as you will see in the long-term chart. For investors who would leverage Netflix or just want to buy normal stocks, I would do it under $600. If we're not in a correction phase, the stock would have at least 11% to 28% from today's prices, and if it extends, 55% would be possible, which is very unlikely. I wouldn't buy right now because the stock should decide in the medium term whether it's more likely to correct or rise. For investors who want to shift to another stock that offers great potential, I would sell Netflix step by step and invest in the next stock. Now I'll show you the long-term chart. My long-term expectations are between $1,300 and $2,000 per share. And if we consider my next target zone at around $600 or slightly below, the stock would have a chance of at least 117% to 234% in the next 2 to 3 years. You would clearly outperform the market significantly with a safe stock. It's very realistic when you consider the growth. Don't forget the giveaway and see you next time.